Hi, I'm Steve Richardson. If you're struggling to make the payments on your federal student loans, then there is a new income-driven repayment plan from the U.S. Department of Education that you may want to look into. Now, there are various income-driven plans that are offered, and you have to look at each of them to see whether they're right for you. Now, the new payment plan is called REPAYE, R-E-P-A-Y-E, and that stands for Revised Pay-As-You-Earn. Now, the Pay-As-You-Earn plan was released a few years ago as an improvement to income-based repayment. It shortened the maximum period of time for income-based repayment from 25 years to 20 years, and it also reduced the percentage of disposable income that signaled financial hardship. In other words, under IBR, financial hardship was if your regular monthly payment under a 10-year plan was more than 15% of your disposable income, and under Pay-As-You-Earn, that dropped to 10%. But there's a catch. It was only for people who started borrowing and took disbursements after October 1 of 2007, and then took another disbursement on a student loan after October 1 of 2011. So basically it was for people that were in college at the time the payment plan was released. But now we have REPAYE, and REPAYE makes pay available to everybody. It doesn't matter when you took out the loan. But there are some catches. For example, it's 20 years instead of 25 years, but only for undergraduate loans. So if you went to professional school like medical school or law school, or went to graduate school for like an MBA, those loans would be on 25 years. So you would have to track two different repayment plans under REPAYE. Second of all, under Pay-As-You-Earn and under IBR, if you're a married couple, your spouse doesn't have student loans, and you file separate tax returns, then your spouse's income doesn't count in the income calculations. Under REPAYE, it does. No matter whether you file separate tax returns or not, your spouse's income counts in the income calculation. Third, if your payment under your income exceeds what the monthly payment would be on a 10-year fixed repayment plan, then you have to pay it under REPAYE. Under Pay-As-You-Earn and under IBR, it was capped. So you basically had the best of both worlds. If you couldn't afford to make the regular monthly payment under a 10-year fixed plan, you paid less. But if you made enough to make the regular monthly payment under a 10-year fixed plan, then you paid no more than that. But under REPAYE, you could actually end up paying even more. Now, the loan would be paid off sooner, but you don't have as much control over what the monthly payment would be. So, these are repayment plans that you have to look at carefully to see if they're right for you. So, if you are struggling to make the payments on your federal student loans, and you're looking into whether REPAYE might be a good option for you, and you live here in southern New Jersey, please feel free to give my office a call. I'd be happy to sit down with you, look at your situation, and find the best repayment plan for your student loans.